Hey there, Wall Street winners. I am going to talk to you this morning about an email that I got that I just feel needs to be discussed. And so I subscribe to something called Sublime Trading, and the intentions in this email are good, but I've been trading for more than 30 years. I've had my share of wins, my share of losses. Fortunately, grateful that my share of wins has far outweighed my share of losses. But it's common when you start trading to have a loss, have multiple losses, and it's important as to how you recover from those. But emails like these are troublesome to me because I find they can be a little bit misleading, and their intentions are good. They want to give you 5 ways or a 5 step game plan to be successful in the stock market. But there's a lot of questionable information in here from my perspective. And I I think that the real winners in the market, and this has been said by multiple individuals, are the people that control the market. The people who make money, whether investors win or lose, are the trading firms, the brokerages, the investment companies. So if you go into it with that approach, which isn't dissimilar or unlike that of the casino metaphor that the house always wins, unlike the casino metaphor, I do not view investing as gambling. If you view investing as gambling, I think that's the wrong mindset to approach it with. Investing is about, yeah, putting your money to work in firms that are hopefully good, solid firms. So I completely avoid penny stock firms. I want Fortune 500 quality firms that are doing great things that I'm often a consumer of. Call it Microsoft. I own Windows. I use the Office platform. I use some of their Azure platform. Or Amazon. I buy services all the time through Prime or goods through Prime. I use Prime for my television on all televisions. Um, so those are examples. Netflix is another one. Walmart, I go to quite frequently. Costco, I visit almost on a weekly basis. Those are firms that are structurally important. Facebook being another one that have huge capital investments that are making money, that are generating cash flow, all the things that you'd want in a small business. If you were to invest in that, you'd want to look for in a large business. They're hiring, they are not laying off, they're growing in market share and growing in customer base. So as we run through this, I do believe that step one is correct. Shift your mindset. But and again, don't approach it like a casino, but I do believe in chasing short term wins and taking short term wins. So maybe not chasing them, but taking them. Because here's a great example. Monday, we had an announcement. Call it out of the blue. It wasn't really out of the blue. It was out of the blue to a lot of people, but this company been around for a year. But the announcement was around DeepSeek, and DeepSeek was an AI startup out of China. If you'd been investing in any of the semiconductors, which are rock solid companies, right? These are not fly by night startups. They have hundreds of millions, if not billions of dollars in infrastructure to generate and produce semiconductor chips, memory, all of the stuff that goes into the computer data in data computers and data centers. Um, these are solid organizations, and they all took a hit of multiple double digits, 10 or more percent downwards. So you weren't chasing anything there. You were investing potentially for the long term. But if you had have taken some profits and sold, then you may have actually missed that. I was sitting in a huge cash position, which I'm very grateful for. And it was just coincidental, but that's been my trading strategy for this month because of expected volatility. And I was able to buy in at a huge discount. And I'm now riding that recovery wave back up. So I'm not chasing anything. I'm just choosing my time. So I would disagree with that. Number two, follow a simple strategy. Great, great plan. If you don't know anything about investing, start dollar cost averaging into an S&P 500 index fund and just let that money grow. Don't even think about it. Don't look at it. Just put in whatever amount you can afford to on a monthly basis into an S&P 500 index fund. Now, the one thing I would add to this is think about where you live. So I'm Canadian. I live in Toronto most of the year. I live in San Jose del Cabo in the winter, or some other country that's warm in the winter, and travel around. But wherever I travel to, I'm typically spending the American dollar. So as a Canadian, I keep most of my money in American dollars and I buy American stocks. The US stock exchanges are the biggest in the world. The Canadian exchanges are, no offense, but a bit of a joke. Um, we don't have the kind of volatility or the kind of money in our country. And the same is true of European countries and other countries with exchanges. Mexico has an exchange. Many countries have exchanges. Get a significant amount of your money into American dollars and trade on the US exchanges. So I know you're going to take a hit initially with foreign exchange. At some point, though, like in the last 5 years with COVID, the US dollar has been on par or lower than the Canadian dollar and many other currencies. So use times like that to put some money into a currency that you're going to need to use when you travel abroad. Most Canadians travel to the US, so why you wouldn't have some, if not a significant amount of your money in to invest your investable money in US dollars is kind of beyond me. It seems like a very simple strategy. So follow that strategy and stick to it. Avoid portfolio killing mistakes. I agree with this. I have overtraded and I am trying to reduce the amount of trading I do, and I'm trying to sit in profitable trades longer. Believe it or not, when you're making money in a trade, it can be very hard to sit in that trade and continue to watch it go up because you have fear now that you're going to end up see it take a dive and come down. So you have to come up with a strategy you're comfortable with to take a certain amount of profit out at certain times as it hopefully continues to go up. And you then can start to take out those profits and look for other opportunities. Because again, things don't continue to go up. And if they did, it would be bad because then they come down, crashing down. So we do want them to go up and down, but take your money out. So, for example, a month ago, I plowed a lot of money into Goldman, and I did very well with Goldman in January with earnings. But it's now kind of peaked where it is right now. And I got out too early, and I missed some of the run up. I made a very decent profit in that investment. And then I moved a lot of that money over into technology, and that's done well. And then when we get through the tech earnings cycle towards maybe the end of next week or the week after, probably mid February, I'll probably look at something else, another sector. Maybe I won't put it into anything because the first month and a half has been extremely profitable. And I'll just wait on the sidelines for a bit of a correction, one of these out of the blue announcements, like a deep seek announcement, but maybe in a different sector, right? We've got a lot of variables coming at us, a lot of volatility potentially. On February 1st, we have Donald Trump saying that he's going to implement 25% tariffs on Canada and Mexico, maybe 10% on China, maybe more, maybe less, maybe no tariffs at all. But if those come out, and you're sitting in the market and the market corrects, you're going to get penalized. So, understanding these different events and when they're set to be announced or when announcements are set to be made is extremely important. And taking your profits to minimize your risk is critical as well. Trusting bad advice, I don't take stock tips from friends. So, if a friend says, buy this company, I'll research it and look into it if it falls into my investing criteria. But if it's a mining stock or a penny stock or some nonsense stock, I'm not going to plow money into that. I'm going to stick with the strategy that is working for me. Holding on to losers. So I've fallen into this category before. I'm holding on to a couple of losers now that have taken a hit over the last year. Um, and I probably, in hindsight, should have sold these when they took a big hit. It's a hard thing to do, but I do believe, and they're a small percentage of my portfolio, that they're still good companies. They're still making money. They're just out of favor right now. And I do believe they'll come back. Now, the trade off I have to make is what am I losing in terms of opportunity cost for those dollars invested in the loser that could be in a winner that could be making me more money if I sold and take the loss? And I do tend to sell my losers at the end of the year for tax selling reasons and take a loss on some of them. I've started to sell a portion of those losers. So not 100% of the holding, but maybe 25, 50, 75%, depending on my feelings on the sector and the potential for a recovery in the following year. But a lot of the companies that I invest in with my strategy pay a dividend, and most of them are 3% or more. So if I'm making 3% and I can hold that for 6 months to a year, it's like I've got a GIC or some kind of fixed income investment where I'm getting paid, but the dividend's taxed preferentially in comparison to a fixed income instrument. So I'm holding that, hoping to get my capital back, but getting paid on that invested capital at the same time. So that's a trade-off. Now, if you're in a non-dividend paying stock and you're holding it, different story and a different set of variables to consider. And then building a resilient portfolio, number four. So here you have some invest only in strong stocks in uptrends. Agreed. That's a very smart thing to do. But if you had have done that with Nvidia, you would have got crushed on Monday and you'd probably be bleeding right now. So it doesn't always work. Most of the time, it's a good strategy, but there will be unexpected events that come along, like Monday with DeepSeek's announcement, and the key here is to not get frazzled and sell. Hold on to those winners because they will come back. So don't cut your losers before they drain your portfolio. If your loser in this case is Nvidia, because in the long term, Nvidia is a market leader. It's creating some incredible technology. It's one of the few companies out there that are manufacturing the chips required for AI. And even DeepSeek was using Nvidia chips. They were just an older version. The last point, let your winners run. So to do this and get over that concept of fear of loss or fear of missing out or just fear of losing with your winners, sell a portion of your winners. It can be 5%, 10%. Take some of the money off the table to secure some profit and let that run, or implement stop losses at certain levels that guarantee you exit your full position at a certain level. Stop losses don't always work. You have to be aware of that. They work well during the trading day. But if you set, let's say a stock's at $100 and you set a stop loss at 95, so that if it continues to move up to 110, you could choose to sell it there. But if it dropped down to 95 in the trading day, you'd get out at 95. If the market opens and that stock's at 50 or 75, well below your 95 stop loss, you're going to end up selling it at 50 or 75. And often what happens is there's a bit of a dead cat bounce there and it comes off the 50 and maybe runs up to 75 and you miss that $25 return or recovery in the stock. So when you have a stop loss in place and stocks drop like they did Monday at the open and they were down significantly, then they trigger and you're out of all your positions. And if they do end up recovering throughout the day or the week, then you're out of those positions and unless you bought back in, which you're probably hesitant to do because you just had a major loss, then you're not going to see the recovery element of that. So you have to be careful with stop losses. They don't always work as you intend them to. And then learn from the right people. This is key. And I hope you're enjoying the videos I put out on this channel. I'm a seasoned investor. I've taken my lumps. I've lost a ton of money, but I've also made a fair bit of money. And I've made more than I've lost, fortunately. My percentage returns on an annual basis are typically in the mid 20% range. So beating the index most years. And I'm an active trader. I wouldn't say I'm a day trader. I don't really like that word per se because it has some bad connotations. I feel it's more like gambling day trading, but I do trade almost daily and I trade aggressively when stocks are moving in an upward direction. But I have a great deal of experience to share. I hope you're enjoying some of that experience. I hope I can share some market trends with you and you can benefit from those. I'm happy to answer any questions you have because one of my passions is just helping to educate people on how to invest their money and get it working for them so that they can enjoy more of the things that life has to offer. If you're liking these videos, please hit the like and subscribe button, and we'll share more with you in the future. Good luck in your trade.